movements are going to continue through the day, through the morning, at least through the first half. But the big story is going to be the rupee, which is opened at a 5-month low. I'm going across to Vishwanath Nair to talk a bit about it. Yes, Vishy?
Right, so the rupees come on about 26, 28 basis or paisa lower on open. This is the lowest that the rupee has opened since February 10th, at about 87.70 odd. That's where it's trading at this point in time. This was widely expected, of course, that there would be a sharp downward movement in the rupee. This is because of the outcome of the trade deal that is happening at this point in time. Of course, Donald Trump last night coming in and saying a 25% tariff will be applied to India, and on top of that some penalties because of the deals that India has with Russia on energy as well as military equipment. Traders were jittery already yesterday. We saw a very wide movement, about 25 to 30 paisa on the rupee. Yesterday's trade, this was also because of the uncertainty that persists as far as the rupee is concerned. The day before, there were already comments that a 20 to 25% sort of a tariff would be implemented on India. Clearly, their worst fears have come true now, and you're seeing that impact on the rupee.
Quick word from Jayesh Mehta, Vice Chairman and CEO, DSP Finance. Do you expect this to continue, Jayesh? Of course, a positive for exporters and some mitigating factor as this all clears out. But what do you see directionally as far as the rupee is concerned?
I think technically, yes, we haven't seen that much of all the way the impact should be, so which is good. But I think market is also kind of looking at there could be some, softness coming in, which is what has happened at most of the places. So that's the reason we didn't really see touching the, lower point of 88 plus kind of a number, right? So naturally, 1 or 2 days market will look at it. There is also a fear that at 88, RBI will also come out strongly to sell. But again, if this is going to last for a longer period of time, then we will see a new low. Otherwise, this is more or less kind of settled. People are expecting the things could change, which is what has happened with most of the country. You start with higher tariff and all that, and when you finally sit down on the table, it comes down lower. But that's the hope trade, I would say, rather than anything else. And at the same time, we have continuous selling from FPI, if you really look at last 1 month, right? So that's also not helping the rupee to a greater extent. And if this US things last for long, I'm not sure at what level will RBI will kind of intervene very heavily. So I think they will also intervene, but very, very softly, just to provide some liquidity. Beyond that, I don't really, look at them to intervene big time.
So therefore, then if you mentioned the hope trade, right? If there is no resolution to that effect in the next 48 hours, which is by the time the currency market stopped trading on Friday, do you reckon that we could see substantially lower levels, or the extent or the bulk of the damage is done already?
No, we can see further lowering from here, because positioning wise also people have been short dollar rupee. Then we don't know. People will kind of start guessing it. People will take the reverse position. People will start guessing it whether central bank will really intervene or not, right? So from that perspective, we may see, another 50, 70 paisa kind of move happening if this continues for a longer period.
Jayesh, we'll leave it at that. Thank you so much for coming in and giving us this very quick perspective. Very important to have you today. So thank you for your time. As the pre-open rates have settled, we are likely to start off about 1% lower. So slightly worse off than what the implied open may have indicated about an hour ago. So bear that in mind. But keep an eye out for the ones with the, perceived highest exposure, right? So Wellspun is starting off about 6% lower. You have KPR Mills and some of those other textile companies starting off lower. Vari is about 3% lower. Zentech, by the way, for completely different reasons, continues to grind lower, and very few pockets in the green currently. So that's the long and short of how the pre-open looks like on the top 500 stocks. Slightly beyond that, there could be more downticks as well. But time for the big brokerage call of the day, and Jefferies has released a note on Wellspun Living, and no surprise that the stock has been downgraded to a hold on account of the tariff headwinds. How much of this tariff overhang is going to cost the company? I think Mahima should be joining us any moment from now to talk about this. Okay, she is ready. Mahima, take it away.
Right, so Neeraj, as you rightly mentioned, Jefferies has downgraded Wellspun Living to hold and given a target price of 130, which is almost the price at which it closed yesterday. They're saying that tariff headwinds will persist longer than what was expected. Q1 earnings also suggest weakening of overall consumer demand in the US. Plus, demand scenario could worsen because of this higher tariff. Indian players would likely have limited advantage relative to China and potentially be at a disadvantage to players like Pakistan, is what the note is saying. Plus, Wellspun has a very high exposure when it comes to the US exports. It's almost 65% of the total revenue. So, the major impact will be on this textile company. Tariff rate would also create significant headwinds, both in terms of volumes as well as margins because of demand going down, and plus they might have to absorb the overall tariff cost. Management shared muted near-term outlook on demand with pressures likely to continue in the near term. They've already told that in their yesterday's con call. And Jefferies has cut the EPS target for FY26 by around 15%. So that's a big EPS cut as tariff headwinds extend longer than earlier anticipated. So this is the overall view of what Jefferies has over Wellspun Living and why they've downgraded the counter.
Okay, so Wellspun in pain as expected. Shrikant, on some of these, are you seeing recovery trade or a contra trade possible? And LT Foods as well, I would add to a Wellspun, a KPR Mills, a Webhav Global, a Wari Energies. Would you look at any of these right now, or this is a clear let's stay away till things clear?
No, I think it is better to stay away from taking any specific position in these stocks which are likely affected. And it is better to focus on those companies which are really doing well in their overall business, and they can do well in the and they are more specific to domestic story. So I think it is better to stay away from taking right now any contra position in these stocks.
Change when the markets open in 3 minutes time, but it looks like it's going to be a poor breadth. There's just one Nifty 50 stock that is in the green post the pre-open session, and that is Mahindra and Mahindra. The rest of the stocks are in the red, and you have only 9 out of 500 stocks of the Nifty 500 that are trading in the green. Among them, GVTND is looking like it's got a strong start. HEG posts its numbers. Again, a positive start. You have Sagility that is up about 1.4%, but not really too much else. Zentech, another 5% down today, and no buyers in the stock, only sellers. LT Foods also losing about 3.8%. Initial rates, of course, this could settle, but it looks like it's going to be a tough situation. Parag bhai, we've spoken about the fact that this could be a little bit of a short-term negative. Are you spotting any moves today, something like a Wellspun Living, something like an LT Foods, that you would venture into because there's a dip that could settle later?
No, as I said, as we discussed, Navin Fluorine is something which has also high export or HUL Limited, for example. This kind of companies can be looked at on if they decline more than 2-3% or 4%, because some of these chemicals which they make are not possible to be made in India, made in US, as Puneet was also saying, or some refrigerant gases, for example, SRF. Navin Fluorine, all those companies make. These are not possible to be made in US. So I would say that if this company decline too much, then there's an opportunity, including Atul. But there are some companies which are seriously, for example, this textile company which you said, the numbers also were not that great, and so and this pain will continue. So even for some of the auto component companies which are competing with the companies where some of those competitors have a plant in US. So they'll definitely become uncompetitive if this 25% duty plus penalty, whatever, stays. But I am hoping, this is my hope, that is a pressure tactic, which I told yesterday evening also. And they want to stop. They want to actually pressurize Russia to come on the table and stop doing Ukraine war. And and plus Trump has also said that within a week we'll come to know, and we are still negotiating with India. So I would say that some of these outcomes which we are discussing right now will change.
Parag bhai, sorry, I'll have to intervene here because the markets are about to start, but I get your point. I take on board your point. Let's see when the change happens. But thank you so much for joining in today. Shrikant, stay on. We'll be just taking a quick opening thought from you. But the market starting off on expected lines, about 180, 190 points lower. Banks, relatively domestic, right? So therefore, not too much of a direct impact, but I wonder if IT is seeing some bit of pressure today. Yet again, actually it's pretty okay. Maybe the impact is at the broader end of the spectrum, mid caps and small caps very quickly. 1% lower for the mid cap index, small cap index, which is a peppering of these names. Yes, under more pressure. Let's get the heat map up on the screen. You'll probably not see too much on the Nifty. But yes, what you're seeing on the Nifty is that one lone star, which is also just about 0.5% higher. Otherwise, it's a tick of red across. Tata Motors for acquisition reasons down. Reliance because of the tariff reasons down. Then there is a Titan, Eicher, Reddy's, etc. No big bang dip or hit on pharma. That's the other interesting observation, that the top loser is down 2% not because of tariff reasons, and only one pharma stock in the top 10 losers. Well, that tells you a story about how the market is likely taking it. We're off the lows straight away as well, but early days. Let's wait and watch how this counts. Tepid start.
Yeah, Shrikant's technical pick there on the top with Eternal. Because I suppose the thinking is no matter what happens, people are still going to order their food and order their groceries online. That domestic move doesn't end. Think domestic right now. Mid cap 150, 1.5%. This is going to be painful. We'll get the market breadth up in a bit when we can and we have enough data. The small cap 250 also 1.5%. Let's pull up the sectoral heat map. This is going to be a sector specific hit. Two things are happening here. No one believes that Trump is going to finally settle at 25%. He himself says negotiations are still on. The second thing is that the impact on India and GDP relatively in larger terms is not frankly that much. So let's not panic about it. Oil and gas is down for entirely different reasons. I mean, crude has dipped again another $2 or so overnight because of these Russia sanctions and the threat there. So which is why you're seeing that play out. Nifty consumer durable also down. I mean, everything is in the red right now. It's only relatively who's less hit. FMCG stocks would be in that category. Remember, HUL will also report today. So watch out for that. Nifty Finance Bank. So all of your domestic focused sectors are doing relatively okay. And here, underline the word relatively is what I'm talking about. Let's pull up the advanced decline ratio. Yes, the breadth will be quite negative starting off, and you can expect that. One stock in the 30 stock Sensex is in the green, 3 in the Nifty, and overall on the NSE, of course, you're seeing a very, very skewed kind of advanced decline ratio. Let's take a look at stock specific action, and I'm going to start with results because at the end of the day, that's what matters once this tariff dust settles. Mahindra is the first stock that I want to talk about. Despite good results, 1.5% down, and this could be some of the tariff flow going through. Interglobe was on our list. We told you they did well in a turbulent quarter, and in that context were good. So is Aster DM. So you're not seeing too much of a hit on some of these counters. Sagility, again a decent set of numbers. CAMS not quite so. CAMS was definitely painful. Sagility 4.5% up. I mean, they deserve a different set of applause. Be 4.5% up on a day like this. CAMS has seen non-mutual fund revenues dip a fair bit, so that's also 4.5% down. Tariff impact. Let's pull up some of the textile stocks. Vardhaman, Wellspun, KPR Mills among them. LT Foods because of high exports to the US, basmati rice largely, all of them down in the red. Wellspun worst hit because of that Jeffries note as well. It was our big brokerage call this morning if you tuned in. KPR Mills, Wari Energies, Gland Pharma, some of these with exposure to the US seeing pain coming in. Wari Energies about 4.5% down right now. So you're going to see these all through, and I think picking the stocks that could recover the fastest or that are relatively tariff immune would be key today.
Yeah, you said it. And speaking of recoveries, Navin Fluorine, we spoke about this. It could potentially have an impact on account of tariffs, but the numbers were particularly good. And so therefore, from the low point that it saw in the pre-open session, it was down about 3% at the start. It has recovered quite dramatically. It's currently trading up over 1% or so. But I do want to ask about HEG, which is up about 6%, reacting to numbers. Shrikant Chauhan, any trade here? This is a stock, of course, that has very seasonal performances on the earnings front, and it sees spurts of performance on the stock front as well. Is there a trade here? Shrikant?
Yeah. Yes, the stock has crossed its important resistance level at 560, 565. And whenever we see some activity in HEG or graphite, most of the time we see trending sort of activity. And this time also, despite of weakness in the market, the stock has broken 560. So I'm expecting stock to move towards the levels of maybe 600, 610 in the near term. We should look for adding stock at current levels, more on dips because the market is under pressure. So in case if there is any weakness close to 560, 65 levels, certainly we should look for adding some more position for HEG. We are bullish on it.
Absolute pleasure as always having you, Shrikant. Thanks so much for joining in. We're joined now by Saurabh Mukherjee, who is the founder and CIO of Marcellus Investment Manager. Saurabh, as always, thanks so much for taking the time and good morning to you. I wonder how much attention you're paying to everything that is coming from the White House and from Donald Trump's Truth Social account, because that seems to be where the news breaks nowadays in the United States. And there's quite a bit of pressure tactics seemingly on India to sign a trade deal.
Yeah, I think this must be a precedent to sort of tailor-made for journalism. I have to say, for financial journalism, there's always every day something for you guys to discuss. I think like everybody else on your channel,
that and comedy, Saurabh.
Yeah, so I mean, you can't ask for a better package, right? Drama and comedy together every morning for the global financial audience. But in all seriousness, this does look like brinkmanship. What struck me was the fact that it's come less than 24 hours before the deadline. So it's very interesting that he made this announcement 24 hours before his own self-imposed 31st July deadline. And that's what I think makes it so clear that this is a pressure tactic. My reckoning is in the next couple of months, India and America will crack a deal. We will end up, I strongly suspect India will end up with tariffs better than the 25% angle. I think Parag Bhai mentioned the Russia angle, and it's pretty clear that Trump is using this as a way to browbeat India into reducing its purchase of Russian oil. I'm not so sure that will succeed. I think India quite rightly buys Russian oil because it's cheaper than the stuff available from elsewhere in the world. So it's not something we'll do a lot of trading around. If some of the companies that we like, for example, Divi's Lab has been a big holding for many years. If that comes off dramatically, we'll buy some more of it. But I don't see anybody in the right mind deciding to sell high quality names like Divi's Lab on the back of this. In any case, I think IT, pharma, electronics, I think will be exempt. Even if this 25% tariff were to go through, it's high chances that the three big Indian exports to America, pharma, electronics, and IT will be completely exempt from this. So you're largely focusing on small pockets of pain such as textiles and auto. And whilst we have some exposure there, for example, we are shareholders in Sona Comstar. Again, if Sona Comstar comes off dramatically on the back of an announcement like today, we'll think of buying. So it's not a sell trigger for us by any stretch of the imagination. It's par for the course. We've all got accustomed to this. In fact, our global compounder strategy actively looks to buy on the back of the American president's tariff threats. We bought heavily through April when Liberation Day was announced. American stocks came off. We bought American stocks heavily through April and are sitting pretty on those gains through May, June, July. So Taco, Trump always chickens out as a well-established trade in America. I suspect will soon become a well-established trade in India.
Saurabh, hi, good morning. Yes, this is a lot of, I would say, fun in heavily quoted terms for financial journalists because Trump is keeping us on our toes. What's on this buy list? What's on this tariff hit buy list? Would any of them, for example, textile companies make it to that list? Would it be pharma companies? What do you think is the right way to make the most of what could end up being a taco trade?
So look, I think it is very, very clear that America needs India on two fronts, right? America needs India to reduce its dependence on China for electronics, Apple being the star play there. And America needs India to reduce its dependence on China for active pharmaceutical ingredients. Remember, China still supplies 70-80% of America's API. India supplies the remaining 20-30%. So America clearly wants to diversify away from China in those two areas. It's not evident to me that countries like Vietnam are beyond a point credible alternatives to India, right? So there is a big China plus one trade there. America knows that. America knows that India wants to step into China's big shoes in electronics and pharma/API. and therefore they are leveraging that to say, let American agricultural produce and dairy and poultry produce into India, and that's where, as we all know, is the stumbling block. So my reading is there will be a deal that will get done over the next couple of months, and therefore we are resolutely positioned in companies that can play the pharma API play. So Divi's Lab is a big holding for us. In our small cap portfolios, we also have a company which used to be called Ami Organics. It's now called Acuitas. I don't quite know how to pronounce it. ACUTAS. So in our small cap portfolio, we have that. The electronics piece, we have not yet been able to make purchases, right? Clearly, Dixon's is the star play there, but it's eluded us. It's an electronic manufacturing services play has eluded us. We continue to do more work, and if courtesy Mr. Trump, the EMS plays become cheaper, if Dixon tanks, then so much the better. We will think of looking at EMS. There's plenty of good companies in that space. We'll think of looking at buying one. But these are two big trades. I think they will become big parts of the Indian market, EMS and API. These will become big parts of the Indian market in the years to come. And I think the trade deal will eventually get done.
By the way, the markets are steady at that 0.5% downtick. So bear that in mind, with banks also now kind of putting that little bit of pressure, 0.5%, more than 0.5% now for the Nifty bank as well. Saurabh, there is a fair degree of chatter around how in these uncertain times, and God knows this is only the first 6 months, the next 3.5 years also promise to be uncertain, that it might be better to focus a lot on domestic plays as well. So if you're looking at pharma, could people look at domestic CDM or a domestic foremost players, or some of the other buckets which are largely insulated from the global uncertainty? Would that be a good way to approach the portfolio construct right now?
So I think yes and no, in the sense that even if you were to look at domestic, I think we are an economy which has, leaving aside America, we have other strong linkages with the global economy. So it's difficult to say that let's completely leave the world aside and focus on India alone, because it doesn't work like that. And in any case, even if we were to focus on domestic stocks, the domestic economy is not in the greatest of shape, right? If one were to say, let's forget the world outside, focus on India only, I would say domestic capital goods companies would be the area of interest. That's an area we're looking at carefully. My reading is we are in a domestic consumption downturn, which will last for a few quarters yet. I think the job situation is fragile, and that's leading to an extended downturn in consumption. I think domestic consumption rates or savings rates will have to go up, which means consumption will come off, I think, in the next few quarters, if not the few years. And therefore, if one is to focus on India, then domestic capital goods plays would be the place to look at. Corporate India, as we know, for the first time in its history, corporate India has net cash, right? And that net cash will get expended. That will get expended as the capex cycle begins. I think L&T's results 2 days ago were heartening in that regard, because L&T announced a big thermal power order, BTG order from a domestic power generator. I hope that sort of triggers the beginning of a private sector capex boom in our country.
Speaking of results, since you mentioned Larsen & Toubro, Saurabh, I'm just wondering, we've got most large companies that have posted already. What is the scorecard looking like for you? Is it more disappointing than anything else? Of course, there are pockets. There are pockets that are bright. Larsen & Toubro is one of them. But are you more disappointed than not?
No, I think we've been expecting this. By and large, for the last 4 results, we've been able to grow EPS in our portfolio by around 10-11%, whereas Nifty EPS growth has been around the 4-5% mark, right? So courtesy the strength of our franchises, e.g., I'll just give a simple example, HDFC Bank, right? As the rest of the banking and NBFC sector copes with asset quality stress, it's HDFC Bank's champion credentials on underwriting are coming through. And this is exactly what I've seen in market cycles, right? When there is euphoria, then nobody wants to buy thoroughbreds like HDFC Bank. People would rather buy a third-rate lender which looks optically cheaper. And then inevitably, when the economy slows down, that's when the thoroughbreds credentials come to the fore. And HDFC Bank is able to chug out EPS growth or a Lab is able to chug out EPS growth, or a Pidilite is able to chug out growth in difficult markets, in difficult economic circumstances, and therefore quality reasserts itself. So I think the quality reassertion trade is very much back on in India in the last, especially the last 2 quarters. And given geopolitics, given the domestic consumption downturn, I think the quality trade will stay on for the next few quarters. And I can't but cheer that, right? That's been our style of investing. Our style of investing took a backseat in the euphoric years after COVID. That's when people migrated to value. But as euphoria subsides, quality is coming back.
Okay, Saurabh, just a couple of more minutes with you, please. I want to introduce Vikas Khemani also to this conversation that we're having this morning. It's an important one to temper the concerns that you're seeing in the market. And the concerns are valid because it's feeling like a bit of betrayal, for a better word. Vikas Khemani, I want to know what your thoughts are. We spent an inordinate amount of time trying to hammer out a deal and then to summarily just, be handed over some formula and then the back and forth on it. Do you think that the weakness we're seeing in the markets right now is an opportunity or it could get worse? Vikas, the question's for you if you can hear me.
Yes, I lost the last part of the question. I don't know if you can
my
repeat
question
that.
is, do you think that the weakness we're seeing in the markets right now is an opportunity or things could get worse?
So I think, first of all, see, whenever these kind of negotiations happen in such two large economies, these kind of things are bound to expect. Let's not forget our UK negotiation lasted more than a year and a half, right? And of course, if you have to give away a lot of things, access to the Indian markets easily, I think those negotiations can be done very easily. So I think fact is that our government has done a great job in terms of protecting the interest of a lot of other segments. You can't kind of just agree to certain things and give away a lot of other segments because there's long-term implications. So I think these kind of tactics are par for course happens in a long negotiation, long kind of trade agreements. So I'm not structurally negative at all. I mean, this is, in my opinion, first of all, not a permanent outcome. It can be there for a quarter or two, but I am quite confident that the eventual outcome will be sorted out. There will be negotiations from both sides. Both US and India need each other. There's no denial on that. And I am quite sure that this will happen. Having said that, there are some segments which might get impacted in a shorter term, but which is a very, very minuscule part of the market overall. Overall export to US is very less. And secondly, also impact does not have to be fully on the earnings. In the sense, a lot of tariff will be passed on. In shorter term, there might be some minor impact can be taken on the margins, but I am sure eventually it will be passed on. Just like India controls 45% of the US medicine market in the generic space. I mean, they don't make that with margin to absorb. So it's a question of only a 1 or 2 quarter of time, which happens in many industries all the time. And secondly, I think partly currency depreciation can also provide some cushion, which we have seen. So I think
I'm just going to interrupt you for the latest truth social bomb. Trump has just put out a post. I just want to add that on to what our viewers are understanding right now. He has posted, "I don't care what India does with Russia. They can take their dead economies down together for all I care. We have done very little business with India. Their tariffs are too high, amongst the highest in the world. Likewise, Russia and the USA do almost no business together. Let's keep it that way and tell Medvedev, the failed former president of Russia, who thinks he's still president, to watch his words. He's entering very dangerous territory." I don't know now what's happening and what the context to this is. Has he gotten off some call and then started posting out, and why India is getting dragged into this?
I mean, there's nobody who can call India's economy a dead economy. It is the fastest growing economy in the world. So I'm pretty sure that it is the result of some sort of a conversation that he has had. Possibly.
But it's just ridiculous.
This is ridiculous. This is just ridiculous. To have a post like this is just ridiculous.
And they can take their dead economies down together. I mean, Vikas Khemani, this is just breaking real time. So we're just putting out what we're getting real time. There is measure. There is something to say about measure, the way India responds. We're a mature nation. We deal through proper channels, etc. But now this is becoming vindictive, isn't it?
See, those who know Mr. Trump, I mean, I don't think I need to comment on that. We have seen he operates through Twitter. I mean, we saw what happened between the US and China. for a very long time, and there was kind of retaliation, all those things happened, and then he nicely ate his humble pie and kind of withdrew from all his and nicely sat down on the table and then did the deal. So I think there are lots of rhetorics which happens. I'm so glad that at least our government is not reacting anything in a public domain, working through the normal channels. I think Trump has its own way of putting pressure on through public media. As long as you don't get impacted by the pressure, and which is what I believe, that I think entire Indian media should also act responsibly rather than kind of pronouncing it in a big way. Let government handle it its own way. One thing we must understand: we are a 1.5 billion people market. US cannot afford to ignore that market. They also make a lot of money from India. Apple does sales, Google does, all the IT company does a lot of sales in India. So see, we must understand that both US and China need each other. There's no denial on that. And apart from the normal pressure tactics, which negotiating, every leader has his own style. We all know Mr. Trump's style. So I'm sure it will get sorted out. India has put its firm foot when it comes to importing Russian oil, even in the worst of the times when there was a lot of pressure. So everybody knows US does what suits them all the time, so in India, with this kind of size and scale, has its own way to deal in its own way. They don't need to preach anything that whom should we import oil from anywhere. And I'm not getting into the politics side, but that's the stance our government has taken, and I think I respect that. So I think we should not panic. Have faith in our system, and I'm sure in fullness of time we will find answer.
No, I think 2 or 3 very key things. That one, a measured approach and through the official channels is really good. The other thing to keep in mind is look at where the action is happening as opposed to just post on Truth Social, right? So I believe what's happened is that the White House officials have said that reciprocal tariffs currently in place have exemptions for goods such as semiconductors, steel and pharma that are or could be subject to Section 232 tariffs. That's part one. And while all of this is happening, there was a Reuters report last night, right, which was speaking about how Google is setting up making a $6 billion investment in the state of Andhra Pradesh for making a data center headquarters of some sort, right? 1 gigawatt data center and a power infrastructure. So look at where the money is coming from. And there will be a case of eating the humble pie, so on and so forth. So I think India is actually dignified in trying to respond through the official channel. I kind of completely agree with what Vikas is saying.
No, that's fine. India will respond through official channels, but that doesn't mean that you can give a free pass to commentary like this.
Yes, certainly. No.
And as media, it is also our job to highlight what is happening. We can't say that, oh, it's okay, no one cares what he says. He is the president of the United States as of this moment. And his actions do have consequences. You're seeing it on Indian markets, maybe relatively less. The fact that he's saying this is a dead economy does show a real inability to understand what's happening, and maybe it's empty words.
It's a dislocation from reality, because I very clearly remember a conversation with the three of us, Ben Powell, making a statement, nobody wants to ignore India, and this is the case globally. You're hearing about free trade agreements bilateral agreements being signed by major economies with India, and those that are being negotiated beyond the United States of America. Yeah. And it's very true. You cannot. And because a statement being made, for example, that apparently Pakistan has reserves of oil, and maybe down the line they will, the US will help Pakistan get those reserves and maybe sell them to India down the line. All of this seems to be scare tactics, pressure tactics, right?
Yeah, so we've seen President Trump, since he has come to the presidency, that how volatile person he is, how publicly, his approach is very, very theatrical and threatening both. So I think there are a lot of times. He's been, which I've never seen in my knowledge of any president's history, who abuses the Fed governor, who is an independent institution. And we've seen all those things, right? But so hence, I would say that markets have started taking that with a pinch of salt. Like I said, have faith in the collective power of the population of both countries and need of each other of country. I am sure in due course of time, Indian government will do its own work. They will do their own work and figure it out. Can US afford to not import medicines from India? That's a question one has to ask. If there was a time when, if you see 2 years ago, US FDA regulator first time came to India, stayed here for 15 days, met pharma companies. Why did they do that? Because of their regulatory overreach, there was a shortage of medicine in US.
No doubt, Vikas, no doubt that they can't do without us. Okay, I have one question for you, but just allow me to break the story. We have an important story, and then I just want a response from you, Vikas Khemani. So give us a couple of minutes. So we're hearing that the Petroleum Ministry is assessing the impact of potential tariff penalties. That's the exclusive we're getting from government sources. Shrimi, in fact, is joining us with all of those details.
Yeah, so the Petroleum Ministry, Tamanna, is closely examining the implication of potential tariff penalty as it's await the executive order from US at this point of time. In fact, sources tells us that Indian refiners have already diversified their crude sourcing and bringing in oil from suppliers such as US and Brazil, and in an effort to mitigate any kind of supply disruption. But sources do indicating at this point of time that since if the imports from Russia curtail, then that point India may need to further diversify its crude basket. And in fact, they are also saying that this may create some disruption given the point that currently India import 35 to 40% from Russia, and that may interrupt the entire and push up the India energy bill. The sources also indicated that currently they are in talks with the refiners. They will be having a meeting with all the Indian refiners at this point of time. The Petroleum Ministry is having a discussion with all stakeholders. But if you see the numbers, Tamanna, we have seen that crude import from Russia has risen 8 to 10% in last few years, particularly after Russia invasion to Ukraine. So, the bill, if you see from 5.6 billion, it raises up to $58 billion, and that is huge. So that's the concern Petroleum Ministry is raising. However, they are studying and waiting for the executive order on that. In fact, if you remember on the tariff penalty, earlier this month, clearly the US President issued a warning saying that secondary tariff of up to 100% could be levied if countries continue to trade with Russia. And, recently it says that the penalty go up to 500% on India and China since they continue to getting energy supplies
right now
from Russia. So, at this point,
right now they're numbers, but the fact is 35 to 40% of India's crude is coming in from Russia for India, and diversification is always there. Shrimi, good to see some green on the screen, even if it's from you right now in your frame and not on the markets. So thank you for that. So at least we have some green on the screen there. Shrimi Chaudhary there in that Haryali, while as markets are completely red. Vikas Khemani, now this is the tricky bit. The fact is that cheaper crude, relatively cheaper crude, is something that the Indian economy needs. How do you think this moves forward? And would you look at more domestic focused companies while all of this settles in?
I think, see, India, if you ask me, is a very far more domestic economy than export-oriented economy. It's very well known. It is a story of infrastructure build-out. It's a story of consumption. It's a story of import substitution, and of course, related export. The export is a very small driver of this at this point in time, and nothing changes at, we are the youngest demographic country, which is kind of not only producing and consuming. So that continues to remain so. And I don't think this event writes off export story. Let's not, because ultimately India has its own core competence in the segment and sectors, and our tariffs are not worse off than China or anybody else, so that we become extra competitive because of this. So there could be 1 or 2 quarters of displacement, tactical adjustments that happens whenever there's a big policy change, and it will be passed on. So regarding your energy question, I think, again, we will have to wait and watch. Recently, I was hearing the interview of our petroleum minister. He had very clearly said that there are They have already planned many sources of supply of oil, which they are anyway kind of looking at alternatively as well. And they were sounding very confident that if something were to happen, we have a game plan in place. So I think good part about our government is that they are very, very proactive in the inflation management ever since they have come to the power, whether it is food inflation or energy inflation, anything and all. And they have done. They understand this very well, that inflation can be a very big risk to our big growth story, which we are working out. And I'm quite confident that the appropriate measures will be taken to manage that.
Because I'm trying to understand what do you do in a time like this as a public market investor? I mean, is this a good time to sit on the sidelines and wait for the event to pass and have some clarity? Or would you preempt the possible outcome, which might be lower than 25%, and use dips, if any, to your advantage?
The fact that at a market open I'm chatting with you clearly shows that there's no point in reacting anything to that right now.
Sorry, Vikas. I was laughing out so loudly that I missed your answer. Can you repeat that answer again?
So the point is, that tells you my approach, that I think never react to these kind of situations. It is not structural in nature. It is tactical. It is not permanent. So, and it is not significant. So, why to kind of, in fact, that market is only down 0.5% also tells you that it's not significant. Also tells you the response of the market by and large. And anyway, we are in a correction phase of the market for some time. Markets have done well, and hence it's good, nice consolidation to happen. Think about the bigger picture. As an equity investor, you always like to have a situation where RBI cuts rate by 100 basis points and liquidity infusion. That's a great scenario for equities, right? And markets have not still responded because of this whole tariff saga over the last 3, 4, 5 months, right? Once this settles down, how much this would mean, you can assess. So in my opinion, I always say that what RBI governor has done and is doing is far more important than what Trump is doing. And hence, focus on what is happening back home, focus on what is controllable. And I am sure there will be opportunities out of this also, and there will be risk out of this also. You assess your own individual portfolio companies, impact on that, permanent nature, temporary nature, and then make appropriate call. But today, I am sure nobody would have proper information to make appropriate call, structurally speaking. And there's no point in reacting to any tactical thing.
Got it. Because thanks for putting that into perspective in the best possible fashion, especially the last answer. We'll remember this, but really appreciate your time. Thanks for joining in. That's Vikas Khemani. And well, I think that the tone and the messaging said it all. Okay, let's move on to some corporate conversations. KPIT Tech, first one off the block. Revenues came in flat, however, margins saw a dip. Puneet first Johnson with all the details. Puneet.
Well, thanks so much for that. So it was largely a quarter of consolidation for KPIT Tech, and we did have some kind of idea with the weak numbers coming in from all the IT players. Revenue was down in this particular quarter, largely flat to a negative bias, but the company had deal wins about 240 million, and they are anticipating a larger recovery to come in the second half of this year as well. But I'm now joined by Mr. Kishore Patil, the co-founder and the CEO of KPIT Tech. Mr. Patil, a very good morning to you, and thanks so much for joining in. Let me just start off first with what's leading to the optimism for you at KPIT Tech in terms of operational performance, given the weak quarter one for this quarter. What are you seeing right now that makes you so optimistic of a recovery in the second half of this fiscal year?
I think overall, as we have been saying, I think we have a very good pipeline, which we have. You can see the wins have been pretty strong in the last year or so. The point was, which I also mentioned a few times in this, is the clients have limited budget, so they do what they have to do. They have to prioritize. Some of the new wins have come from their prioritization area. And to some extent, it can get cannibalized with some of the existing work. I'm not necessarily saying what we do, but overall, it can impact, the current part also. And this budget limitation was mainly because of the uncertainty and the pressure they are facing. Now, the geopolitical issues, tariff, China, there are multiple issues in the world which can't get settled, everything. But I believe in next quarter, at least some of the fundamental issues will get, there will be more certainty issues don't get resolved. But I think what the market is looking for is certainty. Once that certainty happens, I think we believe that many of these deals which we have been, they will start ramping up. I think that's what I'm saying. And I do believe that it should happen in a quarter or so.
Mr. Patil, largely, you are mentioning that deal wins would help you ramp up in the second half, but from clients, we've not seen any kind of discretionary spending. So, essentially, do you see that the ramp up of the current deals, which might take a couple of quarters, will lead you to the growth, or is it that the deal wins that you saw over the last 3 to 4 quarters will now ramp up and lead to growth over quarter 3 and quarter 4 for you?
So, as I always mentioned, I can only talk about my business, which is more to do with actually the product, right? We deal with the product and not generic IT. So, in terms of a product, if you really look at the clients has to take out new products. They have to put new features in the product. So, there is a certain reason why they have to do it, and they have to maintain the existing products. So, I think that is there. Now, what people are looking at is how you can do, and there are certain things, right? As I said, there are budget restrictions. So what they are trying to do is in the current program, how they can add more functionality, how they can give something more to the consumers in the current program, because looking at how much time it takes and how much money it takes, it will take maybe 3 years for them to come out with the new programs. So most of them, then they have pushed out that part to 3 years, and then what they were supposed to do, I think they are trying to accommodate in the current program. And that puts a pressure on in terms of new features to be accommodated in the current architecture, again, the validation and etc. I think those are the opportunities we see. Also, I see the opportunity in the new market as there is a change in the markets. I think people are exploring. Everybody is exploring new market. Everybody is looking at US, but I think there are different challenges. But Europe or any other parts, right? So I think that's another part. So I think we are looking at where there is an opportunity and focusing on that.
Got it.
The other part, as I have mentioned in the earlier, that off-highway and commercial is an area of focus, and we believe that during this year you will start many of them adopting new technologies. So that is the other part I see as a growth from the US perspective specifically, while it is across. So there are specific things, and of course I believe in India story, and there is a lot happening in India. And many OEMs are also eyeing India market. Sure. So I think these are some of the opportunities, and we'll tap into those.
Well noted, Mr. Patil. And Puneet, thanks for getting us that conversation. But now, so that's KPIT. Now let's focus on HUL because the numbers are out. Mahima joins in for that review, and Mahima, optically, the revenue seems to be in line, but the bottom line is above estimates.
Yes, absolutely. So it's a good set of numbers, I must say, because HUL has posted a muted set of numbers for quite a few quarters now. A good 7% growth in profits is certainly positive. Revenue also a good uptick of around 4% odd. Margins were expected to be in that range of 22% odd, and they've come at that 22.3% odd, lower end of the band that HUL has already guided for. EBITDA is also almost in line, slightly below the estimates, but overall in terms of where the YY numbers stand, net profit has seen a good growth of 7.6%. EBITDA has seen a flat growth, a slight growth of around 1.3% odd, and margins, as I mentioned earlier, 22.3%. In terms of segmental revenue, home care surprisingly this time has seen growth, which was one segment of pain because it has seen a degrowth in the past 3 to 4 odd quarters, saw a growth of around 1.8%. Beauty up 11%. This segment has been doing well for HUL in the past 3 odd quarters now, and that has held momentum this quarter as well. Personal care, again, good growth, around 6.4%. Foods, which was a negative growth in the last quarter, has again bounced back in the green territory and up 4.3%. Other segments have also done well, up around 6% odd. So this is the overall view of how HUL earnings have fared, and it's a good set of numbers. Much better than what the street was expecting in terms of PAT. But overall, also muted set of numbers in the past few quarters gives confidence that this quarter is better than what it has done in the past 1 year as well.
Before we get to the analyst comment from Naveen Kulkarni, just Mahima, if you can break down the categories, the segments, because I think the food business seems to have done better.
Yeah, so like I mentioned, food business has seemed to have done better, which is up almost 4.3%, and this was not the case last quarter. This had actually charted a negative territory. It had seen a negative growth of around 2%, but this time it has gone ahead and done well, around 4,000 crores of top line there. In terms of home care, also it's done well, around 1.8% of growth at 5,700 crores. Beauty and well-being has seen a good growth of 11%, and overall personal care has also seen a good growth of around 6.4%. So good segmental growth as well. None of the segments have seen any kind of negative growth. So that's a positive point.
Okay, Mahima, thank you for that. Naveen Kulkarni joins in. He's CIO at Axis Securities. Naveen, very good morning to you and thank you for your time here with us at NDTV Profit. Is this a positive surprise? Is this in line, and does it give you some confidence that at least for the major FMCG companies, things are turning around?
Yeah, so overall, broadly the revenue growth is in the range of around 5%, which is overall okay. Category-wise, I can see that beauty and well-being has done well. Home care has been, let's say, around 2% growth. Personal care has also been okay. In fact, personal care has been good. Foods business has also done well. Home care has been, I would say, that slightly slower. That's why the overall growth rate looks to be in the range of around 5%. Margins seem to be slightly under pressure because some bit of, I think, gross margin pressure has been there. But overall, I would say that these are decent set of numbers. See some bit of improvement on a sequential basis. Things seem to be slightly picking up better than before. Of course, the pace of pickup is not that great. But overall, I would say that things are improving on a sequential basis is what I can see. Some bit of growth is also coming back in categories.
What's your call then? If I mean, FMCG has been struggling for a better part of the year, right, Naveen? Do the numbers give you the thought to kind of change the stance if you had a negative stance on HUL or some of the other FMCG names?
Sorry?
I'm saying, do the results inspire any confidence? Because otherwise FMCG has been, for lack of a better word, pretty insipid.
So I would say that these numbers are getting to be little better, but is there anything which says that it has become significantly better, or are we going to see sharp improvement in nominal growth rate? I don't see that as of now happening. It will take some bit of more time. Maybe second half of this year is where post round about Diwali time, and post that we should actually start making better sense of that. But I would say that at least categories seem to be growing. None of the categories are declining. So there is an all-round improvement is what we have started to witness now. How it sustains and how it picks up is going to be an important aspect that we need to check. But there is improvement, and some bit of encouragement or inspiration can be taken from this kind of results.
Well, Nestle, ITC, how are they racking up right now?
So, of course, HUL compared to Nestle, of course, is cheaper. Nestle results were not that great. ITC is much cheaper. It's completely a different category. It's a regulated category. Profitability there is much higher. Maybe volume growth could be better. So, ITC might be a better stock compared to HUL at this point in time. But, of course, we need to see how that pans out over the next 6 months.
Okay, ITC, HUL, Nestle seems to be the pecking order. Very short break. Thank you for that, Naveen. We're coming back with a conversation with Anish Shah on the numbers. M&M holding out in a very, very tough day and a turbulent market trade because of stellar numbers. That conversation after the break.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
हेलो बोलिए मैडम, डब्बा ट्रेडिंग कब से चल रहा है पता है मैडम आपको? हम और आप तो जन्म भी नहीं हुआ था हमारा।
We investigated a shady advisory firm that has spent big bucks on advertising on the front pages of national dailies.
ये आपको बिल्कुल उसका ऐसा हल्का सा भी खौफ नहीं है।
मैडम एक बात को खौफ किस लिए रखना चाहिए तो बताओ, कौन सा गलत काम कर रहा हूँ मैं?
After our report, we also saw NSE came out with a cautionary circular to the investors. Market Regulator Securities and Exchange Board of India has also come out with a release talking about the actions that it has taken. Cyber complaint has also been filed against the entities involved in this entire Dabba trading scam.
The markets move fast.
And so should your portfolio. Expert insights, real-time stock picks.
Joining us on the show is Dr. Anisha Group CEO and Managing Director at Mahindra Group. Dr. Shah, always a pleasure to speak to you at NDTV Profit. My first question coming to you is, with everything that's happening around, the industry environment is seeming to be muted. Within that, M&M has really delivered well in terms of the first quarter. Outlook is also seeming to be really promising. What is giving you this confidence?
Good morning, HUL. It's a pleasure to be here with you, and I would give a lot of credit to our teams across all our businesses. This has been one quarter where we've had a very strong performance across a large number of businesses, in fact all of them, and you see that in the results. And this is not just about this quarter. As we look at the last 4 quarters, we've had a profit growth of 35%, 20%, 20%, and 24% now. And we're starting to continue to fire on all cylinders and continue to grow from strength to strength. It has been a tough market. A few of our markets have been muted in their growth, but our teams have delivered a very strong performance in terms of market share. Auto leads the pack with 22% growth in a market that's been relatively flat, resulting in a 5.7 percentage points gain in SUV revenue market share. Farm has got its market share to 45.2%, up 50 basis points. Never easy to grow that much when you're in the 40s for market share. And that is the highest ever that we've ever seen in any quarter in our history. And across our businesses, TechM, Mahindra Finance on a very good path. Life Spaces, Holidays doing very well. Sustain business delivering what it has to, which is a very significant set of goals. Logistics is turning around very nicely and will show a strong growth momentum. Among our smaller growth gems, Excello has shown a very strong revenue growth, and multiple other businesses are on a very good path. So it's really been a combination of all of these businesses coming together and helping us deliver these results.
Right. Exactly. I mean, firing on all engines, Dr. Shah. But the key from here on is, yes, no concerns in the non-automotive segment when you talk about tractors. But a couple of, questions that did come in from analysts as well on the automotive side is that EV is seeing a ramp up, which is a positive, but that's somewhere having an impact on the margin perspective. With that, you're still yet to accrue benefits of the PLI scheme. How does that entire dynamic work in for this year and the coming quarters?
Every new launch for us has an impact on margins in some form. EVs has a greater impact because it's a new platform, and that was an investment. PLI helped us make that investment. So we are on track in terms of what we had planned for. And as we maintained, EV margins will get at par with auto margins as we move on and as we grow volume in EV. So it's something that we feel is essentially par for the course and will allow us to have a stronger presence in the market with a very good set of electric vehicles and a very good set of ICE vehicles at the margins that we feel are reasonable and consistent with what we've done in the past.
Right. How are you looking at the export markets, Dr. Shah? Because you have seen good traction that's coming in terms of South Africa. Australia, you've recently begun. And US has been on the radar, but now with the tariffs coming in at 25%, does the strategy still remain the same, or how would you even look at the US markets?
So we've got a very clear strategy for exports, which is consistent with what we've done for all our businesses, which is focus on a few key areas, do that really well, and then think about doing more beyond that. So our focus right now, beyond the India-like markets, which is Sri Lanka, Nepal, Bangladesh, etc., is really on South Africa, Australia, and Chile. These are markets where we've been present for some time, and with the new products we have, we are targeting a 15 to 20% market share, which is very, very significant in those markets. We are well on track on those markets right now. We will look next at either Southeast Asia or Europe. And the US was planned after that, which really may be 5 to 10 years down the road. So at this point in time, can we feel good about where we are? We feel good about the FTAs that the government has been signing that will allow us to do more. And that's something that I think is, again, on course for us at this point.
Right. And Dr. Shah, that we've spoken about tariffs right now and overall market sentiment commentary, taking into consideration the various businesses that Mahindra Group is in, how would you actually decode a 25% tariff that has been announced?
Hiral, it's not material for us right now, and we are very confident the government has been always focused on ensuring there's a good balance, and that's what they will do. So I'm not really worried about it.
Okay, so that's a positive commentary on that one. From a sentiment perspective, if you have to look at rural versus urban, rural sentiment has continued to be better than urban right now from a market perspective. With the upcoming festive season, the interest rate tax cuts, how are you seeing that pan out from business? Are you seeing that recovery also coming in urban now?
It's a surprise why urban hasn't picked up as yet, because the fundamentals are very much in place. We are seeing more liquidity, we are seeing lending going up to some extent, at least, maybe not as fast as we'd want to. Interest rates have come down, and from all of those perspectives, urban should start picking up. Our sense is it's because of sentiment, and sentiment often requires a few triggers to have that turnaround. Festive season could be a very good trigger. It has been in the past, and I personally feel that the second half of the year will be a strong one for urban India and for the Indian economy overall.
Right. And when it comes to the other crisis that the auto industry was facing was rare earth. How are you seeing an impact in terms of M&M, or is M&M also looking at substitution measures from here on? And secondly, the rising commodity prices, because that is something that could put pressure, particularly steel and precious metals. So again, that dynamic overall.
So Hiral, the silver lining for a crisis is that it makes you stronger. And we learned a lot from the semiconductor crisis. And that has helped us tremendously in rare earths right now, because we've had to find substitutes for various components. And again, our team has done that very well, which has really taken away any concern for us. So at this point, we are not impacted, and there are a few things we still need to close for 2 or 3 quarters out, but we feel good that we will be able to close that as well. With regard to commodity prices, yes, that is a concern. We are seeing a significant increase in steel in particular, and a few other commodities as well. And that's one that we will pass on to the customer. We've taken some price hike already. And we just hope that it doesn't go on too much, because we don't want it to cause inflation once again. But there again, on balance, we feel that it will settle down, and the overall trend from pricing and inflation is good, and commodities is one that stands out, but that again we hope will settle down soon.
Right. Dr. Shah, with regards to the 15th August platform launch, I think this has been something which has been really spoken since quite some time, much awaited. Anything that you could tell us, because that's something which everyone is tracking, and the analyst day which will be slated in November?
I will just say it's an exciting platform, and we look forward to sharing it on August 15th.
Okay, we'll wait for that. And with a peer coming in the form of Tesla, what are you hearing? Because, you know, when we talk to analysts as well, the commentary has been that there are reasons why M&M can actually beat Tesla in India. How would you look at that aspect of competition?
Well, we've got a wonderful set of products, and the feedback we have from customers is very, very strong. And based on that feedback, what we see of products, the only thing I would tell any customer is, please drive our product and then compare it with anything else you want, and then make a choice. Many have done that, and many have made a choice in favor of Mahindra, but that's the message I would give to all consumers.
Right. Dr. Shah, one last question, not from an auto perspective, but with what's happening in the IT industry. In fact, a very recent commentary that I heard from Mr. C.P. Gurnani as well, where he said, "Kitne aadmi the?" And it explains why TCS's layoffs are a sign that a Sholay era is what is in the offing for the IT sector as a whole. How are you looking at it, and are you seeing concerns that AI is bringing in?
I think, Hiral, the Sholay era was long gone, because the IT industry started with call centers, which is where it was really about headcount. It transitioned from there and has made multiple transitions from there as well. So I would not read too much into TCS's announcement. Sometimes that's required from time to time. That is unfortunate, but I would not read too much into it. I think the industry has shown the resilience to continue to transform, to add value in different ways. Technology continues to be a very significant part of our lives overall, both as consumers as well as companies. And therefore, IT services companies are going to play a key role in every step of transformation that we see in technology that will cause them to continue to transform how they provide the services.
Okay, but Dr. Shah, just a quick one. Will we see a similar action that could happen at a Mahindra IT firm as well? Because that's the way the trend is panning out across the sector. So are you seeing concerns from that area where you could have to take decisions like that?
So we are not seeing concerns at this point in time, and I sincerely hope that we do not have to take any such actions at any point in time in future. We do care for our associates, and at this point, as I said, we don't see any need for that.
Okay, so that's Mahindra and Mahindra. So much news to capture this morning. I mean, before we get to our first story, I have to pull up the HUL chart. What is going on there? Numbers have been greeted with complete cheer from the street. Look at that intraday coming up. Just looking absolutely fantastic. So a strong set of numbers. The commentary coming from the management is enthusing. Just a reminder here, their conference will be at 11:15. We will be live with it. You will hear from the management and our questions to HUL as well. So that's turning out to be a star of the morning on an otherwise weak day. It's a bad day for listings though, and possibly, which is why you're seeing a weak listing for Brigade Hotels. It's listed at a discount of nearly 9%, recovered now 5% down. What are the key risks to watch out for as far as the business is concerned? Anushi's joining in with more.
Right, so if you are looking at a Brigade Hotel Ventures IPO, it's a decline, that is what we are looking at, and as compared to the listing price of 90. And there's a couple of reasons that why we should be focusing on and as to why the street is not cheering this particular IPO. Now, first of all, if you look at the room addition and the ARR growth, that has been comparatively lower than its peer set that we are looking at. And this is over the course of FY22 to 25 data that we've pulled out indicating the same. In fact, apart from the new inorganic opportunities that the company is eyeing out for, majority of room additions also will take place post FY22 FY28 or FY29. So the trajectory of growth in terms of how 26 and 27 pans out is something that we should be watching out for. In fact, if you look at the growth also in terms of revenue, they've derived 63% of revenue from just 4 properties situated in Bangalore. So high concentration is what we are looking at as well. In fact, if they terminate any agreements with Accor or Marriott, that stands as a risk point of view as well. Do note that the company had incurred losses in FY23, so this continuing any subsequent years is something that we should be focusing on. Just about the company now, Brigade Hotel Ventures, it is owner and developer of hotels specifically in key cities in India across South India that we are looking at. It has a portfolio of 9 operating hotels with about 1,604 keys and intends to develop 5 additional hotels. Most of the hotels are managed by global hospitality chains as Marriott, Accor and Intercontinental. Their objects of this issue pertain to repaying certain borrowings for its subsidiary as well, SRP Prosperity Hotel Ventures, which is currently loss making as well, and pursuing other inorganic growth opportunities as well. So this is the overall picture that we are building for this IPO.
Yep, and certainly sulking today. Anushri, thanks a lot for that. Let's get in Vaibhav Sanghvi, CEO of Ask Hedge, to talk about how is he viewing the scenario currently. Vaibhav, good having you. Thanks for joining in. You've run a long short fund successfully. I believe you probably still have that option. I would love to know, how are you viewing at that opportunity in the Indian markets currently? If you had a chance to be short, would you be majorly short, or would you believe the bulk of the damage in the last 800-900 point correction is behind us?
See, I think apart from what earnings had to deliver, I think the events, if we kind of line up, then major of the events, to be very honest, are now behind, including your tariffs, geopolitical concerns, and whatever we may name it. I think are something which we are at this point in time from here onwards, we don't see any of those kind of things kind of coming back. Now, in some sense, we can always say that the worst possible outcome is pretty much on the table. And in light of that is where the markets are. So possibly, I think, with some volatility on the downside, I don't see much of a, further reaction kind of coming, from an Indian market perspective because of this event. Of course, what is more important to monitor is basically what's happening into China, the Chinese policy and the flows which are moving towards China within the emerging markets.
Vaibhav, so, okay, that's an interesting way to think. If the worst of the outcome is on the table, yes, agreed. Are the markets pricing in currently the worst of that outcome, or are the markets thinking that, okay, the worst of the outcome is on the table, but we believe that the eventual outcome will not be as bad?
Of course, see, because worst of the outcome is pretty much on there. Anything which has to happen from here onwards has to be better in that sense. Of course, there are few sectors under Section 232 which may further see some amount of news flow if it comes through. But I think most of it is pretty much off the of the desk in that sense. So markets, in my view, from a sentimental impact perspective, has already factored in the worst of the outcome. I'm not saying that they are factoring in any recovery at this point in time, right? So if there is a positive news, which is either suspension of that tariffs for at least 60 days, 90 days, depending upon how the negotiations kind of come about, then you may see some amount of positive reaction coming back to the market as well.
Okay. Vaibhav, what have you made of the results thus far? I mean, are there any green shoots? Are there any, or are you also in the camp? We were talking to Gautam Duggad of Motilal yesterday, who said that while their estimates are 12%, all the client meetings that he did, most of them said कि 5-6% से ज़्यादा नहीं होगा. Where are you on that argument?
See, I think you are absolutely right. The buy side would love to be a little more conservative than the sell side in that sense. But my view is that I think, more importantly, there is diverse, set of earnings, in the sense that we have seen some weak earnings coming from, IT pack. There is some amount of weak asset quality concerns have, coming from few select banks and probably NBFCs. But apart from that, I think the larger private banks have kind of given a pretty good picture. Larger infra companies have been doing pretty good, and consumption has kind of kickstarted the earnings pretty decent, in line with the pre-quarterly updates as well. So my sense is basically from an index per se, if you look at it, IT, we have seen, a very huge correction